Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. I say the word Redfin and either you cringe or you kind of beat your chest a little bit. This is a stock that, depending on when you bought it, if you bought it, you've done either really, really well or you've done really, really poorly. I'm fortunate enough to be one of those that's done pretty well on it. And I'm still holding because I think there is something bright here and a positive future. I'm Jason Hall. This is The Smattering. And I've got somebody here with me who thinks something is rotten in Denmark when it comes to Redfin. That's Tyler Crow, my good friend. Hey, Tyler, you ready to battle it out about Redfin?
We've been doing it at text chains for 6 months.
That's a good point. And we're going to try to be cogent and concise, but I am going to ask viewers to hang with us on this one. This is one that gets a little bit squishy, right? There's some financial stuff we can talk about. We'll talk about the operating statement and where the monies are coming from and where they're going. But I don't want to speak for you, Tyler, but one of the points that you want to make about it is just concerns about business focus, right? So where do you want to start with this?
Redfin, to me, was a good idea that needed one thing, I think, more than anything else, and that was to get eyeballs on its site, to bring people into their ecosystem to sell houses. Their entire value proposition, they have their own agents, the commissions considerably lower than you would see on the traditional buyer, seller, broker transaction.
I want to focus on this for just a second here. So I think for the average person on the internet, they're going to see Redfin and they're also probably going to see Zillow, right? In terms of public companies, those are the two. And a lot of people are just going to say they do the same thing, but they are differentiated in terms of their business model. Redfin, really, it's a real estate brokerage, right? That's their business. They make their money is earning commissions on helping people sell or buy a home, and mainly on the selling side. And then Zillow is more of like the aggregator, right? Where they make money in a lot of different ways. And between the two, Zillow gets tons of traffic. Redfin doesn't get anywhere near as much. So back to Redfin and its business model.
For that business model to work with having brokers that you actually operate with lower commissions, you need more eyeballs, you need volume, you need people coming to your site. And that to me was the original strategy. But somewhere along the way, I think management got too unfocused. They saw the concept of iBuying sprout up with other companies out there. Even Zillow tried it themselves. I don't think that their existing business was mature enough for them to try to take on something else. Lo and behold, they've been having to unwind this iBuying business for almost a year now. And it went to show that I think management got incredibly unfocused. The fact of the matter is they were trying to juggle two things at the same time that were not necessarily related. And you could even argue kind of competing with each other. Because if you're just having an iBuying platform and you just buy and sell online, why do you have brokers anymore? This just looks too unfocused to be a good business right now. And there's part of me that says, even though they've had a good return over the past year or so, I think there's something funky in the financials that doesn't quite read right to me.
A couple things I'm going to agree with you on. I think Redfin, and I'm going to include Zillow in this conversation, and you can look more broadly. There's a couple of other companies that went public, mostly via SPAC, with the idea of this iBuying model, basically house flipping at national scale or a larger scale. These companies got the idea, particularly in this zero interest rate environment or very low interest rate environment where they had ultra low cost capital, that they could move into this business and they could scale them up. And there were economies of scale there. Frankly, I was never one that really saw substantial economies of scale. Maybe a little bit. Yeah, these companies do have better access to lower cost of capital than smaller operators will, but generally lack all of the knowledge that's so valuable at buying these properties right, having access to vendors to be able to quickly do services to flip these properties quickly and bring them back on market at a value add point where you can get good margins. And I never really believed in that. I do agree that Redfin got out over its skis on that in the same way that just about everybody else did as well. And everybody was exposed when interest rates went up so quickly because all of a sudden that advantage of free money to do this went away. And now it actually costs something to do it. So with that said, I want to give Glenn Kelman some credit. It's the CEO at Redfin. did make the decision to act quickly once it became clear that when you could basically do this for free with a low cost of capital, once that went away, they did move really quickly to get out of this business. And I'm going to give them some credit for focusing back on this core business, because that lack of focus certainly created some risk. I want to say this too. You want to go back to late November and then before the beginning of the year, when the stock price bottom dropped probably around between $3 and $4 a share, there was a tremendous amount of short focus on Redfin as being a company that was going to go out of business because debt that it had, some convertible notes, and some concerns about its cash burn that just didn't match up with the reality. And the reality was that the debt was tied to home inventory. Once they sold that inventory, they'd be off to pay the debt. And again, convertible notes that they were going to be able to deal with without substantial dilution to existing shareholders. So you put all that together, and I think what I see is a company that is more focused now because they have to be. And I tend to believe that Glenn Kelman has acknowledged the mistakes that they made and is focusing on the core business. And this is the most important thing, Tyler. And I think this is maybe, I want to hear your counterpoint to this. Thinking about what Redfin does as a brokerage, I do think that this is a business where there are some potential economies of scale, particularly as we see the housing market continue to be competitive. And as a seller of a house, you want to find the cheapest broker you can. And that price advantage that Redfin has in terms of their listing fees and commissions can be really appealing. And again, with their national reach, with their website, I do think they're in a position to continue to win as we see the real estate market for existing properties continue to normalize. I know you don't necessarily completely agree with that.
I don't think you need to give Glenn Kelman too much credit. Seems to have done plenty of that with yet records amount of share-based compensation over the past 12 months, but that's neither here nor there. As much as that could exist in theory and the business model, the financials just don't seem to line up to what's being said here. Yes, they've unwound much of that iBuying business, but there's still a lot of debt. There's over $900 million of debt, and operating cash has ticked back up, but it's because they've been selling houses out of inventory. That's not operating cash from the agent business. So I think the theory of the business all makes sense, but the damage done by the iBuying business might be so substantial that I struggle to see how Redfin is actually going to be able to recover.